This video is going to give you a simple formula to determine if it's worth it for you to do a refinance on your current mortgage. First thing we need to look at is, why are refinances even offered? Why would the bank allow you to refinance at a lower rate when they already have you locked in at a higher rate? And it's because they do make money off of them, so it's not always going to be worth it for you to refinance your home mortgage. Hey guys, I'm Tim Wolf. If you're new to the channel, go ahead and subscribe so you can see more personal finance videos. So the reason banks offer a refinance option is because you can either do it through your own bank or you can go and find a new lender. So they want to stay competitive and not have you go and find a new lender that's going to make all the interest off of you. So that's one reason why your own bank or your own lender would offer you a refinance. The other reason why they do it is because it can be profitable for them, because they charge a closing cost fee to do a refinance on your mortgage. This is what helps them not lose a ton of money off of people that refinance to such a lower interest rate. Also, people will do cash out refinances or start a new 30-year loan when they go ahead and refinance, which means if you're already 5 years into a 30-year loan and you restarted at another 30 years, that's going to be longer that the bank is going to have the loan with you, which means that's more interest they're going to make off of you. First thing you need to do is figure out how much it's going to cost for you to refinance, either through your own lender that you have the loan with now, or try to find 2 or 3 other lenders and see if you can get a more competitive, lower fee closing cost. On average, it's going to cost around $5,000 to refinance your mortgage. Now beware, some companies will offer you no closing cost fee. Well, really what they're doing is they're just rolling that $5,000 fee into the mortgage itself. So there's still a fee that they're charging you. They're just not advertising that you have to pay it up front, which is fine. It's not a bad thing to roll it into the loan, but you have to be aware that that's going to be an extra amount of money that you're going to have to pay back, and you need to know how much it's going to be. The other big factor you have to think about is how long are you actually going to stay in the home you're living in. On average, the average American home buyer stays in a home for approximately 10 years. Now, if you're younger, if you live in a city, or this is your first home that you've ever bought, it's probably going to be less than 10 years. If you're older in age, or you live in a more suburban area, and this is not your first home, you're probably going to stay in that home longer than 10 years. But only you know an estimate of how long you're going to stay in your home. So now we have those two things decided. You need to figure out how much do you owe left on your mortgage. Now, the average home prices I'll list here, it varies tremendously depending on where you live. If you live in San Francisco or you live in Idaho, the average home price is going to be completely different. So whatever it is that you owe on your mortgage, you need to figure that out. For this example, I'm going to use $200,000. So someone who has a $200,000 mortgage that they're currently paying off, or $200,000 left on their mortgage, and they have an interest rate of 4%, that first monthly payment of interest is going to be $667 in just interest alone. The way you calculate this is you take your balance that you owe, the $200,000, times 0.04 on your calculator, because 4% is the interest rate. Or if you have a 3% interest rate, you do 200,000 times 0.03. Take that number and then you divide it by 12, and that is going to be how much you owe in that particular month. Now, obviously, as the balance goes down, as the 200,000 goes to 190,000, 180,000, 150,000, 4% of that is going to be less than what it was when you owed $200,000. After 2 years, you're no longer going to be paying $667 in interest per month. You're going to be paying closer to $650 in interest. So it doesn't change drastically. I'm not going to overwhelm you with all these sort of calculations and numbers, but just keep in mind that the more you pay off your mortgage, more principal you pay off, the less you're obviously going to pay in interest. And let me address one thing. A lot of people say, oh, the first couple of years are just all interest anyway, or there's such things as like front-loaded loans. It's not actually true. I see where they're getting it from, but that's not, they don't look at the amount of interest that you pay over the course of 30 years and go, hey, we're going to charge most of that on the front end of the loan. If you have a 4% interest rate, you're getting charged 4% from the very beginning to the very end. Now, obviously, 4% of $200,000 is going to be a lot more than 4% of $20,000 when you're in your last couple of years of the loan. So yes, in the beginning of the loan, you will be paying more money in interest, but it's not because they're front loading the interest. It's just the balance that you have to pay off is more money. Now let's compare that to $200,000 that you owe with 2.5% interest rate, which is about where interest rates are right now. So if you're looking to refinance to that, you would pay your first month about $417 in interest. Compare that to the $667 that we were paying before at the 4% interest rate. So now we are saving $250 a month in interest by refinancing from a 4% to a 2.5%. Keeping in mind, like I've been saying this entire time, the less you owe on your mortgage, the less interest you're gonna pay. So after 10 years, you might not be saving $250 a month. You might be saving more like $210 to $220 a month. Now we're going to compare that to the cost of how much it is to refinance. So if it was a $5,000 refinance fee and you were saving $250 a month, it would take 20 months for you to get back to where you were, for you to make up that $5,000. So a little over a year and a half. So if you plan on staying at that house for, let's say, 2 years or more, then it would be worth it in this scenario for you to refinance, because you're gonna recoup your money in about 20 months. And when you hit that 2-year mark, you're gonna start saving $200 to $250 a month by doing the refinance. Now, if you plan on moving in 2 years, or you're really not sure, maybe 3, maybe 2, it's probably not even worth the hassle. But if you know you're gonna be in this house for 3 to 5 years or more, and you're going from a 4% to a 2.5% interest rate, then yes, in this scenario, it would make sense. And let's look at the savings you would have over the entire life of the loan. So if you were to do a $200,000 loan at 4%, over the course of 30 years, you would end up paying $143,739 in interest alone. If you were to do a $200,000 loan at 2.5%, you'd be paying $84,487 in interest. So almost a $60,000 savings in interest by having the lower rate. But keep in mind, you haven't been paying the lower rate the entire time if you're refinancing. You may have already owned your home for 5 years and you've been paying interest for 5 years at 4%. So you've probably paid around $38,000 in interest so far. But here's what I want you to take away from that. That's a lot of numbers. The key thing here is the sooner you refinance, the more money you're going to save. Also, if you refinance to a lesser length loan, either a 20-year loan, 10-year loan, 15-year loan, you're gonna save so much more money. If you go from a 30-year and you refinance to a 15-year, not only are you gonna save on the interest rate, but the amount of time that you're paying interest for, you're probably gonna save upwards of $50,000 in interest alone or more. So it's key, if you can refinance to a lower length term, that's where the real savings is gonna be, in addition to the lower interest rate. In conclusion, I'll put it this way. If you think you're gonna refinance from a 30-year to a lesser term, like a 20 or a 15-year loan, and you're gonna save about 1% in interest, it's probably worth it for you to go ahead and refinance, as long as you're not gonna move within the next year or two. And if you have any questions or you want me to calculate it for you, go ahead, comment down below your exact numbers and I'll figure it out for you, whether it's worth it or not. If you got anything out of this video, please go ahead, hit the like button, guys. I will see you next week.